For India, I think it's very clear that the Indian economy has slowed quite dramatically over the last 2 years. Companies have been caught out by that. Their balance sheets have been somewhat suspect. Their debt levels have increased more than they would like. But what they've begun to do over the course of the last year is actually repair that position. And what we've seen with Indian companies is that they have begun to improve their balance sheets again. They've stopped capital spending. That increases free cash flow. Eventually, what that results in is a stabilization in the economy as companies become much more comfortable with their own fundamental financial positions. And that's what we're telling clients just now. India has gone through part of the process of restructuring and rebalancing at the balance sheet level. We expect that process to continue for another quarter or so. But by the middle of this year, the calendar year, we expect that India's economy will have bottomed. Companies will begin to look much, much more attractive, especially the ones that have sold off a lot over the course of the last 2 years. And India will bounce back. It tends to dance to its own tune anyway, and we think it's going to be dancing quite strongly by the end of this year. Not imperative at all. In fact, I wouldn't be assuming any rate cuts even this year. It's quite possible that we'll see further rate increases. But our point would be that at this point in the cycle, companies are not borrowing anymore. They're not increasing their capital expenditure. They've been reducing it for a year. And when that happens, then of course interest rates actually become somewhat irrelevant. It's one of the great myths of the global economy these days, and you hear it all the time from central bankers, I'm afraid, and especially in places like Europe, that we need a credit upswing before the economies can then grow again. That's absolute nonsense. There's never been an economy which has gone through a recession where credit has led the economic growth cycle. It's quite the reverse. And the economic growth cycle recovers on the back of corporate earnings improving, balance sheets improving, and companies becoming comfortable again with their financial position, then starting to stabilise, then starting to grow capital expenditure from retained earnings. So it doesn't actually matter anymore what the central bank does for interest rates in India. The economy will be improving regardless of interest rate levels by the middle of this year. Well, there were very real reasons for the contagion to spread through Asia in 1997-98. Thailand was by far the worst of the countries in the region in terms of its exposure to external debt and the fact that it had a raging current account deficit. But that was also true of Indonesia. It was partly true of the Philippines. It was very true of Korea as well. Not the current account deficit bit, but the borrowing offshore. Even Malaysia had taken on far too much external debt. If you look at the emerging markets just now, there are clear problems in places like, obviously, Argentina, Venezuela, Turkey, a very specific problem with the current account position there. But elsewhere, there have been problems in India for the last few years, and they're now improving. The problems in Southeast Asia are limited to Indonesia. Elsewhere, we see very sound financials, very sound current account positions, and very little in the way of increased borrowing offshore, with the exception of China. So, of course, there are countries that could follow in Asia. I don't think India is one of them. I think China might be the surprise packet here. But elsewhere, the emerging market fundamentals, particularly in Asia, are actually pretty strong.